Is there a crash coming in 2026? I keep seeing this shouted all over the place. Should you be selling your house now before the market breaks? Are the buyers forever priced out of the market unless the bubble bursts? Let's talk about it. So, number one, in 2008 was the last time we had a huge crash in the market. There was a housing bubble. From roughly 2000 to 2006, home prices detached from incomes and rents. Speculation exploded. There were flips, there were no doc loans, there were teaser adjustable rate mortgages, and price growth assumed to be permanent. That's a bubble. No controversy there. But bubbles don't always crash violently. Sometimes they can just deflate slowly. Number two, the trigger wasn't prices of homes, it was credit. What broke the system was how housing was financed. Subprime loans, meaning there were buyers in there that were getting loans that probably shouldn't have been getting them. Alternate A financing on loans, no income, no asset. We didn't care how much you made. We didn't know what kind of assets you had. Can you sign on the dotted line and we'll give it to you? Adjustable rate mortgages that reset higher. Loans were bundled into mortgage-backed securities and something called collateralized debt obligations. And those securities massively leveraged banks. So the banks became the problem. When rates rose and resets hit, defaults spiked. Mortgage-backed securities started failing, which no one thought was going to happen on that. Banks didn't know who was solvent anymore and who wasn't. At that moment, this stopped being a housing problem and became a banking crisis. For a really good primer on this, by the way, watch The Big Short, starring none other than heartthrob and action star Ryan Gosling, Batman's Chris Bale, Steve Carell, and Brad Pitt. You don't want to miss that film. It's about 10 years old, The Big Short. Number three, once credit froze, housing had to collapse because here's the key causal chain most people miss. Credit froze, buyers vanished, prices fell. So the banks stopped lending, even qualified buyers couldn't get loans. Foreclosures started surging, prices dropped fast, not gradually, and housing didn't lead the crash at that point. It was being dragged down by the financial system, imploding around it. So number four, why 2008 felt like a housing crash, even though it wasn't only that. Housing is slow, visible, and personal. Foreclosure signs were everywhere, values dropping on paper. We saw the ads in the paper and online, neighborhoods changing overnight. But under the hood, Lehman's failed, AIG failed, interbank lending froze. The Fed had to back up the whole entire system. That's not a housing-only event. That's a systemic failure. The most accurate framing of this was the housing bubble created vulnerability. The lending and banking system turned it into a catastrophe. If lending had been fully documented, conservatively written, held on bank balance sheets, we likely would have seen a price correction, some regional pain, no global financial crisis. By the way, 50% of all the foreclosures during that time were in 6 states across the country. 1 out of 2 were in 6 states. So why does this distinction matter in 2026? People constantly say prices are high again, and so another 2008's coming. But 2008 required 3 things at one time: overpriced housing, fragile loan structures, and highly leveraged banks holding on to toxic assets. You can have number 1 without number 2 and number 3, and nothing breaks. The bottom line, yeah, there was a housing bubble. No, housing alone didn't cause the crash. The collapse was driven by lending practices and banking leverage. Housing was the fuel, so to speak, and not the spark. So everyone keeps saying another 2008 is coming. There's going to be a crash in 2026. Not quite. Hold your horses. Number 1, housing prices. Same headline, different engine. Yes, home prices are high, just like back before 2008. But here's the difference. Back then, prices were inflated by those risky loans and speculation. Today, prices are high mainly because supply is low and demand is real. Same numbers, completely different cause. What do we say? The houses are where the jobs go at night. And when you're creating jobs, but you're not giving ease of building houses, you're going to create pain there on the pricing. Number 2, lending standards are tighter than ever. In 2008, loans were designed to fail. Subprime mortgages, no doc loans, teaser arms, the defaults were baked in. Now, lenders require full income verification. big down payments, and stress-tested underwriting. People are not getting in on a regular basis on 0 to 5% down payments. In the DMV area, people are getting in at 15 to 20% down. That's the average down payment, so they're very well financed to do that. The system today is built to prevent systemic defaults, not accelerate them. Now, hey, things could change. I know that, but we'll have to wait and see on that one. Anyway, number 3, homeowner equity acts like a shock absorber. In 2008, most buyers had little to no equity. They could not survive a drop in their equity. They had just a few percent down, so falling prices immediately left them underwater. Today, homeowners have record equity and locked-in low rates. That equity cushions against big shocks and prevents mass foreclosures. Number 4, banking exposure. It's much safer. Remember 2008? Banks were holding toxic mortgage-backed securities, massively leveraged, and everything froze when defaults started. So fast forward to now, almost 20 years later, banks are well capitalized, they're stress tested, holding far fewer residential mortgage risk. This isn't just safer, it's a completely different system. But like I said, could things change? Yes, they could. I don't have a crystal ball. Number 5, the interest rate effects are opposite. Back in 2008, rising rates triggered payment shocks on adjustable rate mortgages, causing defaults to spike. Now, most borrowers have fixed rate loans. One of the reasons we have a housing shortage is because of so many 2, 3, and 4% loans that sellers are like, I don't want to sell. I don't want to pay 6% for my money, which is still a really good rate. Number 6, foreclosures are low. They're not exploding. In 2008, foreclosures spiraled out of control and prices collapsed. In 2026, foreclosures are historically low, with most homeowners holding strong or selling voluntarily. Without a foreclosure wave, you cannot have a systemic crash. Number 7, the main risks in 2026 are commercial real estate exposure, regional bank profitability, and economic slowdown affecting employment. Housing might be affected, but it won't trigger a national financial meltdown like in 2008. And finally, the key takeaway, here's the simplest way to put it. In 2008, there was a housing bubble sitting on top of a broken banking system. In 26, a tight housing market is sitting on top of a strong financial system. High prices, yes. Systemic crash, I don't think so. So next time someone says we're headed for another 2008, remember this breakdown. If this cleared up the hype for you, hit subscribe, share it with anyone still worried about a housing crash. And until next video, that's how I see it.